Today we're going to go through the BRRRR method, which is the buy, rehab, rent, refinance, repeat through the lens of a hard money lender. My name is Fernando Corona and I am a real estate investor and a loan officer here to help you through your investing journey. The way I add value to my clients is by sharing with them the entire loan process, as well as how to make money in real estate. So right now I have a client I've been working with that brought me a deal and said, hey, Fernando, I can buy this property for $155,000 and it needs $40,000 of rehab. What's the best way that I can buy it? How much money down will I need? Talk to me about the process. I said, okay, this is what we can expect. So you want to buy the property for $155,000. You got $40,000 of rehab. First question I ask is, what's the ARV, or the after repair value? Meaning, how much is this going to be worth after you repair it and you want to sell it, or if you want to refinance it? And he said, well, the value is going to be around $250,000. So now you got $155,000 purchase price, a $40,000 rehab that takes you to $195,000, and then now it's going to be worth $250,000. All right, so that takes you to about 78% LTV, which is fine. And you got to just keep in mind that as a hard money lender, the max that I will loan on is a 75% LTV. So I will make the buyer or the borrower come up with the additional money. What does that mean to you exactly? So I might say that I can lend between 10 and 20% depending on your skill set on your purchase, and we will fund 100% of the rehab. So think about that for a second. That means if you have this deal, $155,000, right, 40K of rehab, and you're trying to figure out how much money do I actually need as a down payment, and then obviously to cover some costs and all that stuff. So this is where that comes in. So if you're a first-time investor, then you could take 15% and you can multiply that by the $155,000. So that takes you to $23,000, right? $24,000. Then you're probably going to add another like $5,000 in fees, depending on obviously your price range. You're gonna be paying different in fees. But let's just put $5,000 in there. So now it takes you to 28. Let's just call it $30,000. So you're going to buy a $155,000 home, and you're going to need $30,000 to bring to the closing table. That's going to cover your down payment, any miscellaneous fees. Maybe you got prepaids for property taxes, and you got homeowners insurance that you're going to have to pay as well. So all in, $30,000 to buy this property, $155,000. And then you're going to rehab the property. So that's when we're going to give you $40,000 of rehab. But this is the trick, okay? As a hard money lender, after you buy the property, and you now sign all the documents, loan docs, title, and everything, we release the money into escrow, and they're the ones that end up giving the money to the seller. So that's on the purchase. But then what about the rehab? Do we just give you the $40,000 of rehab? Do we just give you all of it up front? No, it's too big of a risk, right? What's to say that you don't just now get that property, you take the $40,000, dip, right, and you leave? So there has to be a way that a hard money lender mitigates that risk. And the way we do that is we do something called a draw, or a reimbursement schedule. What that means is that you, as the investor, will take a certain amount of money that you work with your contractor on. Let's say your contractor says, hey, I need you to pay me in 4 different payments. 25% now, 25% later, 25 and 25, right? So if it's a $40,000 rehab, he might say I need $10,000 up front. And so you, as the investor, would pay that $10,000 up front to your contractor. After you pay that $10,000 up front to your contractor and your contractor completes that work, what happens is I get a scope of work from your contractor, and my team is now reviewing the work that your contractor completed with the scope of work that we were given. And so then we send an inspector out, an inspection, like a draw. There's a draw that the investor pays about $150 every time that you ask for a draw. My team then sends an inspector out to the general contractor's work, and they review everything that was paid for, and they say, okay, yeah, this adds up to $10,000. We're good to go. The work is done. We got photos. Then we send that money back to you, back to the investor, so the investor gets reimbursed. And so then the investor does the same thing. Now they got their $10,000 back. They can give that $10,000 back to the contractor. So the contractor now has 50% of total payment, which is good. Contractor takes that money, goes and buys materials, and continues to do all the things that they need to do on their end. The investor gives us a call, sends me a message, and says the same thing. Hey, okay, my team's completed this next $10,000 of work. Can we get a reimbursement? We send an inspector out there. We charge that draw fee. After the inspector goes out there, takes photos, and evaluates that the work has been done, we reimburse the investor again. So now the investor receives another $10,000. So this is the process. You do that one more time. Now they're at $40,000. That pays off the contractor for all their work. And for the investor, now the investor is paying interest, right, on the money that was loaned. And here's the good news. is that the investor only has to pay the interest on what was used. So if initially you purchase the property and you're obviously going to use the 85% that we are going to lend on the purchase price, right? Because the investor only needed to bring 15% down to that initial purchase. So we fund the other 85%. So the investor's gonna be paying interest on that other 85%. In the meantime, as they do their draw schedule, they're gonna have to start paying interest on the money that they're drawn. But in the beginning, they do not have to pay interest on that rehab of $40,000 because it's not money that was borrowed yet. They can go the entire process, and this has happened to me before, where my contractor only needed me to pay 25% up front, and then they let me cash out refinance and pay them at the end. So there was 75% of my rehab budget, and my rehab budget was like $90,000. So 75% of $90,000 I did not have to pay interest on because I never pulled the money out. And so that's always beneficial, where if you think you have a relationship with your contractor and you don't have to pay the entire amount up front, and maybe they might wait for you to sell it or to refinance out to pay them, then you don't even have to take 100% of the draws. So that's just one benefit that I wanted to share with you guys. But this is the process that a hard money lender will go through. And this is pretty crazy too, because we don't analyze the income of a borrower. We don't look at their prior jobs. We don't look at their tax returns. We don't look at 2 years work history. We don't look at pay stubs. Sometimes we'll look at bank statements if we need to source funds, if we need to find out where did this money come from, but that might be only like 30 days back. So if we're only looking 30 days back, then just make sure you get whatever money you need 30 days before. Now, I do have lenders that I work with that don't require source funds. And in that circumstance, then, we can kind of have that conversation about what we're going to need with you. So what does that mean? Sourced funds. A lot of investors, what they'll do is they'll partner up with private money lenders, even for that 15% down. They want to come and invest with no money out of their own pocket. So they want to partner up with private money lenders. But the reason why a hard money lender needs to know where did you receive this money is they just have to prevent money laundering. I mean, as much as possible, we know you're not doing sketchy stuff. We have to try to prevent money laundering. Where did that money come from? We're not sure, right? And just people just trying to wash their money. So if we kind of have an idea and we're doing our best to check that, hey, this money isn't being laundered, it's just private money, well, then we can kind of solve that problem together. But if you are working with a private money lender, there's 2 ways that I'd recommend you get that money into your account. So that way your private money lender does not need to personally guarantee the loan, okay? Because you as an investor, with every hard money loan that you get, you are personally guaranteeing the loan. So if something goes south, it's not like it's just the business. You are personally guaranteeing it. Same thing with like a business credit card. If you get a business credit card, even if it's under your business name, you are personally guaranteeing that business credit card. The way that works, because people don't want their private money lenders to personally guarantee the debt, here are 2 things you can do. Number 1, you get the money from your private money lender 30 days beforehand so that the money looks like it was in your account, and that way your private money lender doesn't have to be involved in signing any paperwork and being on any docs or anything like that. Okay, that's number 1. Now, if that's not realistic and your private money lender says, I'll give you the money after you find the deal, you want them to be in your LLC. You want them to be in your LLC in the operating agreement as a 1% owner. People who have over 25% ownership of the LLC need to personally guarantee it. And you only need one person really to personally guarantee. And so that's why for me, what I'd recommend is anytime you have a private money lender that's going to lend immediately in that time frame, you want them as a 1% owner in your LLC. It's very easy to do. It's just an edit in your operating agreement that you're going to share with me. Then what's going to happen from there is we're going to get a resolution note that just says from your business partner that has 1% that you are authorized to make decisions on behalf of the business. So it's pretty simple. They sign one piece of paper. They don't have to get it notarized. We don't have to have them sign loan docs, have them sign the title. They don't need to send me their identification, none of that stuff. So that is kind of number 1 of what we would need. And if they're comfortable with that, with the majority of them are, especially when you tell them we're going to do it this way so that you don't have to personally guarantee anything, they're usually really happy to work with you. So those are the 2 ways that I recommend leveraging private money and getting that money into your deal. So let's go back a few steps. How you initially start to work with me is you reach out and you say, hey, Fernando, I'm going to start looking to buy homes. What do I need? And I say, okay, well, let's evaluate. Let's get you pre-approved. And the way that I pre-approve you is I'll do a soft pull. Okay, I don't do a hard pull. I do a soft pull so I can check your credit. If your credit's already pretty good, then I'm not going to do a hard pull until once we're finally in escrow. I can do a hard pull and we can run things, right? If your credit is like kind of iffy and it's on the edge, then I may do a hard pull. And that's because I need to see ways that we can increase your credit to make sure that we don't run into issues down the line. And I have to be able to further kind of consult as to like what not to do, what to do, things like that. So that way you don't want your credit blowing up the deal, especially if you're raising private money. So I am there as a consultant so I can help you get through those challenging times if your credit score is lower than we need, and we're going to be ahead of it, so you can still be looking for deals, and at the same time we're working on building up your credit. So after I run the soft pull, after I see the proof of funds in terms of the type of capital you're going to have, then I can start to issue pre-approvals, right? And so if you're telling me, well, Fernando, I don't have proof of funds, there's different ways that I get proof of funds. Okay, the first one I can get through a brokerage. So if you have a brokerage account, you don't have to pull money out. I can look at your brokerage account and I can say, okay, this person has this much money in their brokerage account of liquid assets. You can use that as proof of funds, even if you're not going to pull from it, right? Even if you're going to use private money, but you don't want to ask your private money lender to take a screenshot of their bank account, then you can just use your own brokerage account. Same thing with your 401k. You can use your Roth IRA, your 401k. This is just to show me proof of funds that you have the capital, so that we know you have a down payment. Okay, this is how I pre-approve people. If none of that works, or you literally don't have the cash, of course you can show me a screenshot of your bank account, but if you don't have any of the money and you're really only going to be borrowing it, then in that case, then I would say, hey, can we get your private money lender to send a screenshot of their bank account? And that's really it, okay? If they send you that money 30 days before, like we talked about, then you can just send me a screenshot of your bank account and we'll be good to go. So that's what I need to issue a pre-approval. And then I can issue you like a blanket pre-approval so you can go and put offers on multiple properties. I don't need to issue you a pre-approval for every single property, especially if you're using hard money to buy, right? Usually these homes are beat up, they need work, they need TLC. And so sellers and listing agents are okay, kind of just getting offers in and then negotiating from there. Once an offer is accepted, the next steps that I usually recommend is, you're either doing an inspection beforehand or you're doing an inspection right after offer is accepted. So after the offer is accepted, you're going to get your inspector and your contractor to walk the property. Some people don't even use an inspector, they just use their contractor. I personally will always recommend people do an inspection themselves because this is a big investment, especially if you're using private money. So you want to hire an inspector because they're going to see things that your contractor didn't see. And your contractor is going to see things from like a cost-effective way, not necessarily from like, I need to maximize the work on this property to get the biggest return at the end, right? To meet that after repair value. So having an inspector review the property and go through it, they're going to see things that the contractor didn't necessarily see, or vice versa. So it's just like having two pairs of eyes, and all you do is pay $500 more, right? For having the inspector go. And again, you're spending, this is hundreds of thousands of dollars that you're going to be using. So $500 should be a small cost. Once your contractor walks that property, they're going to create a scope of work, and a scope of work, all it does is lists out all the work that needs to be done in the house. It line items everything out, and the cost, materials. It's kind of more like a project management spreadsheet. We get that, we plug it into our own software, our own spreadsheet, and that's what we use to issue you the reimbursement draws, so that when your contractor says, hey, we completed this work, we can quickly go to the line item of the work that he completed, and we see the dollar amount, and we can go ahead and reimburse accordingly. So people ask us, well, like, how quickly can we close? And depending on the scenario, right, we can close honestly as fast as like 3 days, where we don't have to send an appraiser or an inspector out to the property, and we close as quickly as 3 days. Because I work with different lenders, so depending on the scenario, if you told me, hey, I don't care if we can close in 20 days, well, then I'm going to have a lender that we can put 10% down on, right? It's a different strategy than the lender that requires 15% down, but they can close in 3 days, right? Or you might say, hey, my loan amount is $50,000. Well, I have a different lender for that, right? Because different lenders that I work with are going to have different requirements, and they're going to be used for different scenarios. So reach out to me on Instagram at It's Fernando Corona. DM me the word HML, which stands for hard money lending, and we can talk about how I can help you strategize through getting a hard money loan. At the end of this, I'm on your team. I'm more of like a loan consultant. I don't work for a specific lender. I work with multiple lenders. And because of that, I'm the person that basically does all the work for you to make sure that you get the best rates, the best deal, and ultimately you get the loan that's going to work for your strategy. So I help people on the loan on the initial purchase, and I help people on the loan on the refinance. So there's a lot of information. If you have specific questions, go ahead and drop them in the comments below. If you want to see a specific video that is around the topics or subtopics of hard money lending, let me know. Share this video, subscribe, and I will see you guys in the next video.